Hello and welcome to the Victor for Advice Retirement Educational Webinar, Retirement Planning 2026, How to Preserve Wealth, Protect Income, Reduce Taxes, and Build a More Secure Retirement. I'm Victor Cuevas with Victor for Advice. So why listen to me? Well, I have over 30 years of experience in the financial services world. I was in the securities world for over 20 years, licensed as an investment advisor and fiduciary. I worked in every aspect of financial services, and I started my original career with the 82nd Airborne Military Police and other military police units in the Army, then went into civilian law enforcement for a total of 18 years. And that gave me a protection mindset, folks, which is really lacking in the financial advisory world. You'll see a picture to the right of my wife and me during Christmas, this past Christmas, at a family member's house. And you can learn more about me at LinkedIn or my website. What you'll learn in the next few minutes, we'll talk about market volatility, something that your typical financial advisor doesn't discuss with his clients, the value of a guaranteed income for life. That's really the most important thing you can do is create yourself a personal pension plan. We have tax strategies we're going to discuss and how that can adversely impact your future. And we want to avoid those common retirement planning errors. Again, these are things as far as the retirement errors that most financial advisors won't discuss with you. Retirement in 2026 is a new reality, folks. Today's retirement landscape looks completely different than what it did 25 years ago. I even think about my father when he retired in the 1980s with two pensions, Social Security, and most of his money. He really didn't have a retirement plan, but he had a ton of money in CDs at the bank, earning 10 to 14%. Pretty good return on compound interest. So not like that way anymore. So the old playbook no longer applies, folks. We got cost of living increases when things are never going to get cheaper. We have market volatility going to the roof like never before. We got higher taxation that's going to be likely in the future. And we got longer life expectancy, longest life expectancies ever. It's not what these people are saying. Well, you got a 90% chance of your money not running out in 90 years. That's great. No, it's not. You never want to run out of an income, no matter how long you live, even if it's another 40 years in retirement. Right, the number one threat, market volatility. I'm going to explain it to you the way most advisors won't. Market volatility remains elevated across both equities and bonds, stocks and bonds. Bonds aren't that safe. They're expensive. The last 10 or 15 years, they haven't done well at all, folks. So traditional diversification strategies aren't working. It used to be the 60-40 portfolio. They've been using that for decades. Articles have been written on that the last few years that it hasn't worked out that well. I've even done a video on that that's on my YouTube channel. Can't depend on those portfolios anymore. And folks, listen to me. If you're in the 5 years before you retire or the 5 years after you retire, it's a 10-year window. We call that the red zone. It is the most critical time in your entire financial life. During the red zone years, you cannot afford to lose not one dime of your money. Safe money advisors try to make sure you don't lose not a dime. Your traditional financial advisor will keep you fully invested like they always have. Your money's going to be at risk. You don't want to do that, folks. Let's go into more detail on that. Another name for market volatility is sequence of returns risk. That just means we don't know from 1 year to the next what the market is going to do, up, down, sideways, whatever. Okay? A drop in retirement assets early in retirement can permanently reduce lifetime income potential, even if long-term average returns look fine on paper. A drop in retirement assets just before retirement can literally wipe out 5 to 10 years of income before you even start. Well, how's that possible, Victor? Well, it's easy. You have $1 million portfolio. Your average financial advisor uses the 4% rule. Well, you're going to take 4% out in retirement. That's 40,000, and you're going to give yourself a 3% pay raise every year. We're going to manage things for you. The market's going to do whatever the market does. Don't worry about it. We'll handle it. Trust us. You're never going to run out of money. That's keeping your fingers crossed and rolling the dice, folks. Because if the year before you get ready to retire, you have a 30% drop in the market, and now you're from 1 million to 700,000, you've lost almost 8 years of income. Gone just like that. You're not getting it back. Because now you're drawing the account down, the fees are coming out from your advisor, and you're trying to crawl out of that hole. It's not going to work. And for every 10 years in the market, you have 2 to 3 years that the market is down. And it usually takes 2 years for it to recover. So you don't want to be there, folks. Sequence of return risk matters and leads to threat number 2, running out of money, the number 1 threat. The number 1 fear, I should say, of retirees is running out of money. Now, I put some things into ChatGPT about retirement, especially in the last 25 years, this century. And it says analysis of actual historic sequences show that this effect, sequence of returns, can significantly reduce the real internal rate of return that a retiree experiences, even when the average market return is positive. So don't believe them when they say, well, you know, he got a 6% average return. It's pretty good. No, you didn't get it. It doesn't make any difference, the average returns, when you're in retirement and you're drawing the account down. For example, in one back test with a retirement starting in 2000, the internal rate of return for a retiree withdrawing income was much lower than the market return, sometimes under 1% annually in real terms. How would you like to retire in your portfolio when it's all said and done is returning 1%, less 2% maybe, and you're drawing 4% and giving yourself a pay raise every year? Bad outcomes, folks. So let me kind of explain it a little bit more. I have an S&P 500 calculator. I set it from January 2000 to December 2025, 25 years. Annualized return, 6.2%. Without dividends. Let's take dividends and reinvest them. 8.1%. Dividends aren't guaranteed. We don't know what dividends are going to be in the future. 8.1%. You're saying, well, that's pretty good. Now remember, I'm going to stick with me, folks. I'm going to have a discussion here with you that your financial advisor isn't going to have with you, most of them. This is the S&P 500. 100% in the top 500 stocks in America. 100%. No balanced portfolio. No financial advisor is going to put you in a 100% stock portfolio. He'd lose his license. They're going to diversify you, and they love that traditional 60-40 split. Well, if you have 60 in stocks and 40 in bonds, which really don't do well anymore, you're not going to get 6.2 or 8.1. You're not going to get it because you're not 100% in the highest performing stocks. You've got a mixture of asset allocation of a 60-40 split. Plus, this is based on zero fees. Well, there's no such thing as a zero fee account in the securities world. Your advisor is taking 1 to 1.5% right out of your account into his pocket. He's got to make a living. And then your account, your money is going to a certified financial analyst, a third party who's going to trade that account. And we don't know what the fees are going to be. They're undisclosed. It depends on how much they trade. Let's just put another 1%. Now you're at 2 to 3% coming out of your portfolio in retirement as you're drawing it down, as the fees are coming out, and the market drops 10 or 20 or 30%. You're not going to get anywhere close to this in retirement when you're drawing money out. So yes, you can run out of money in retirement unless you work with somebody like me. It's going to help you create a personal pension plan with some of your money. And threat number 3, inflation. It's not getting any cheaper. It sure is a lot more expensive than when my father retired. It's more expensive than it was in the 90s, and it's going to continue to go up. It's never going to go back to the way it was, folks. If you're getting the kind of returns I just went over in the previous slide, how are you going to keep up with inflation? Threat number 4, taxes. Well, we have this big, beautiful bill that passed. Fantastic. We kept those lower tax rates, but I don't know what they're going to be in 10 years. I don't know who's going to be running the show, so to speak, in 10 years. So we've got a plan for that. Rising government debt. I'm going to go over that. It's a strain on Social Security. Who knows that maybe 10 years down the road, they cut back your Social Security by 20%. And we got RMDs that would force you to take money out, could put you in a higher tax bracket, and kick in IRMA surcharges that could cost you thousands and thousands and thousands of dollars a year. You need to plan for all of that. Tax planning is no longer optional, folks. All right, here's the U.S. debt clock as of the 11th of April, 2026. We see here we're at $39.1 trillion in debt. That's a lot, isn't it? I'm going to put that in perspective. We are bringing in $5.4 trillion. We're spending $7.1 trillion. We have a deficit. We're in the hole, $1.6 trillion. It used to be $2 trillion. We have $355 billion coming in tax revenue, in tariff revenues that may go away. But we're at $1.6 trillion deficit. Well, how are we making up that deficit? We're printing money, folks. We're printing money out of thin air. That's inflationary. It devalues our money. If this continues, you're not going to, how are you going to keep up with that kind of inflation when we're printing money like crazy? So let me go ahead and show you the real impact of this debt clock. Here's 2019, the year before COVID, right? And we were at a $22.7 trillion deficit. $22.7 trillion. We're at 39.1 trillion now. So what, in 6 years, we went from 22.7 to 39.1? In 2007, before the Great Recession of 2008, we were at 9 trillion. And we thought that was crazy back then. Right now, I look at 9 trillion. Ooh, it'd be nice, fantastic if we just had 9 trillion. But from 2007 to now, we've more than quadrupled our national debt. Now, I want you to think about this, folks. Again, this is something your typical financial advisor isn't discussing with you. Where are we going to be 20 years from now? 100 trillion? What kind of deficit are we going to have? How much money are we going to be printing? If those, I'm trying to be nice, those so-called politicians up there in Washington, if they don't start making the hard decisions and getting real with people and saying, we don't need to be spending money on all this freebie stuff. We need to balance the budget. If that doesn't happen, you better be ready. You better have a retirement strategy in place that's going to deal with that. All right. It's fixing to get worse. I don't want to scare you off, but I'm just giving you the facts. Again, no one else is telling you about this. We started the income tax in 1913. The top tax bracket was 7%. Up until that time, we didn't have an income tax in America. It quickly went to almost 80% in the First World War. It dropped during the 20s, and then we had the Great Depression, and boom, it went right up. And during the Second World War, it was at 94%. You'd think it dropped back down after the Second World War. No, during the 50s and part of the 60s, we were at 90%. Ronald Reagan was a popular actor back then. He only made 5 movies a year because if he made 6 movies, he would lose 90% of his income on that 6th movie. He said, I'm not doing that. And he would stop making movies and that put people out of work. So we get into the 70s and we're at 70%. This was in the late 70s. I'm in my 20s. I'm in the Army, got a wife and 2 kids, and we're at 70% tax bracket. Our inflation was 11 or 12 or 13%. You think inflation is bad now. We're low at 3%. Just a few years ago when the other guy was president, we were at 9%. Back when I was in my 20s, we were at well over 10%. Mortgage rates were at 14%. You ever want to see that again? No. Reagan became president in 1980, took office in 81. He knew what needed to be done, and in the 8 years he was president, the top marginal tax bracket went down to 28%. Well, people say, well, look, that 90%, 70%, that was just some rich folks. Folks, listen to me. This is a big lie that you'll hear, that they only want to raise taxes on the rich folks. No, throughout the history of the income tax, all the tax brackets go up. So if you're at a 90% tax bracket, these guys at the bottom are paying 20% plus, double what we pay right now for the lower tax brackets. So now we're here, and from after Reagan to now, we're in that, we're up and down in this channel in the 30% range. We're at 37% right now. So if you look at the history of taxation, we're at historically low rates. I just showed you the national debt. I just showed you how much money we're printing. We talked about the inability of Congress to do anything about it. Folks, there are people, and I want you to listen, stick with me here, folks. This is so important. This is a foundation I'm laying for the rest of this webinar. There are people in Congress right now, believe me, that would love for us to be at a 50 to 70% tax bracket. And if the wrong people get into power, that's where we're going to be 10, 15 years from now, even if the deficit continues to go up and we keep printing money. That's what we're going to be at. You need to be prepared for that. Okay. The hidden threats of required minimum distributions at IRMAA. Look, depending on what year you were born, you're going to reach 73 or 75 and be forced to take money out of your retirement accounts. And you don't have any say-so. This is what you have to take out. That could put you in a higher tax bracket. But when that happens in retirement, it can affect your IRMAA tax brackets, which is the amount of money you pay for Part B and Part D. And it could mean an extra thousands and thousands and thousands of dollars coming out of your pocket for some of you out there. Now here are the IRMAA tax brackets. I'm going to go over this real quick. Let's suppose you're a couple earning $274,000 a year. You are paying $405 in Part B and $37 in Part D. One of you dies. Let's suppose your income drops $74,000. Well, you naturally think my IRMAA taxes are going to be less. No, because you're filing single, and at $200,000 a year, you just went up to $649. That can hurt. And these things go up with Medicare. These IRMAA tax brackets are going up 6 to 8% a year. I don't know what that's going to be 10 or 15 years from now. This $649 10 years from now could be $1,500 a month. So wouldn't it be nice if you could avoid this or greatly reduce the impact of this on your retirement? That's what you need to talk to me about, right? Okay. The retirement income challenge for most of your working life. What did you do? Well, you focused on one retirement goal, saving and accumulating wealth. Put all that money into 401ks, IRAs, watch your balances grow. You did a good job. You have all this money. But retirement represents a fundamental shift in financial strategy. You're no longer focused on accumulating. You're now in a distribution phase. You're drawing those accounts down while the fees are coming out. You need to turn your life savings into a dependable paycheck, and it must last for 30 years plus, and it needs to be guaranteed, folks. You need a personal pension plan. Only a safe money advisor can do that for you. Your typical listen to me, folks. You really got to listen to me on this. Your typical financial advisor, even if he knows this, will never tell you about it, because in order for you to create a personal pension plan, money has to come out of your accounts that are under management. So now your advisor can't collect a fee. I've been in that world. I know how they operate and I know how they think. It's all about acquiring assets under management and never letting that go. So they got to move money over here from money they're collecting a fee in to create a personal pension plan so you can have security and peace of mind in retirement and never run out of money. Their income drops. They will not do that. This transition requires structure, not guesswork. You need a systematic approach to convert assets into reliable income. Well, what are four threats, right? Managing taxes, protecting against market volatility, those sequence of returns, keeping up with inflation, and ensuring your money lasts throughout retirement. The strategies you built that built your wealth are not the same strategies that will preserve and distribute it effectively. Let me say that again. The strategies that built your wealth are not the same strategies that will preserve and distribute it effectively. We like to use a bucket strategy. One bucket could be an income bucket that's going to pay you an income for life, your personal pension plan. Another bucket could be your growth bucket, money you want to grow, and we could split that up into money that's 100% at risk and money that gets stock market returns, but you can never lose. It can go up. You lock in your earnings, you keep them, goes up again, you lock in your earnings, and if it drops, you don't lose a dime, you stay put. Only safe money advisors can do that. So you still get the market type returns, but no losses and no fees. No fees. And you can have some in the market. You can have a tax-free bucket. You can have a long-term care bucket. This is how you can protect yourself in all situations. We like to call it bulletproof your retirement. But what that does is you get protection against market downturns. You have peace of mind. Who doesn't want peace of mind in retirement? You have time for your losses in the market that you might have exposed. You have time for them to recover because you don't need them for income. And you have tax efficiency to save on federal taxes and IRMA surcharges. Case of two retirees. One is no structure, has a balanced portfolio. He's forced to sell in downturns in the market for that income. He's always worrying about what's going to happen in the market. His portfolio depletes in 18 years. You have the bucket strategy retiree. He's never forced to sell during downturns, gives growth investments time to recover, sleeps well because he doesn't worry about market volatility, and portfolio sustains to retirement, secure income, low stress, different structure, dramatically different outcomes. Don't take chances for your retirement, folks. That's what I'm saying. Tax planning, the biggest opportunity in 2026. Look, let me make this real simple. You have a $500,000 portfolio. If you were to liquidate it, you'd be in the highest tax bracket. You're going to lose at least $165,000 to taxes. Minimum. That's way more taxes than you ever saved contributing the money. Well, I didn't have to pay taxes on that money while I was putting it into that 401k. But it just means more taxes in the future. So now, but you're not going to liquidate the account, right? You're going to draw it down in retirement. Well, you're going to spread the taxes over the lifetime. You'll pay even more taxes. And then if you leave anything to your heirs, they're going to pay the tax on it. It gets really, really expensive. Why Roth conversion still matter in 2026? Well, I just showed you where our tax rates are right now compared to what history shows us they were, 70, 90, 94%. Let's go ahead and make those Roth conversions now because we don't know what's going to happen 10 years down the road with taxes. So if a Roth conversion is suitable for you and practical and will make things better for you, now is the time to do it. It's going to reduce the impact on your RMDs because if you have a Roth IRA, you don't have to take RMDs. So there's no consequence from taking the income. And the RMDs, there will be no RMDs for the rest of your life on that account. And all the growth is tax-free. And you leave it to your heirs tax-free. So you might be in a sweet spot. That means you have a few years, at least 5 years before the RMDs kick in. You might be 62. You won't have to take RMDs for a while now, 10 years or more. Well, guess what? Let's get that Roth conversion going so that when RMDs arrive, you don't have to worry about them. And it's not going to affect your IRMA taxes either. Lifetime tax map. Most people think, how can I minimize my taxes in April? Well, let's talk about minimizing your taxes for the rest of your life. No RMDs, no IRMA surcharges, or you can greatly reduce them. You don't have to convert all of your money into RMDs, into Roths, but you need to be thinking about it. Here's an RMD tax table. Suppose in 2026 you're 73 years old. This is the division factor here, but you will be required to take 3.7% out of your retirement. So if you have $1 million portfolio, that's $37,000 you have to take out. That may be just enough to put you in a higher tax bracket and trigger some IRMA surcharges. But some of you are sitting on $5, $6, $8, $10 million in retirement accounts, and that 3.7% is significant. So, and it goes up every year. You see that? So if your financial advisor isn't managing things that well, or the third-party managers aren't managing things that well, just these RMDs going up every year could cost you to run out of money in those accounts. Why don't we just take that risk right off the table or mitigate it a lot? Okay, what do safe money advisors do? Guys like me, well, we kind of operate like endowments or pension plans. See, the world's most successful institutional investors, university endowments, pension plans, sovereign wealth funds, they have some rules that they like to follow. Number one is prioritize risk management. Protecting capital is the first objective. Growth is secondary. They never risk the core portfolio chasing returns. Do they want returns? Yes, they got to grow those endowments. Do they want to lose money? No. Warren Buffett, one of the most famous investors of all time, had 2 rules for investing. Number 1, never lose money. Number 2, don't forget rule number 1. That's pretty good rules. He hates losing money. Another bullet point, focus on future income for retirees. Pensions have to make sure that future incomes for retirees will never be put at risk or interrupted. So pensions have to make sure future incomes for retirees will never be put at risk or interrupted. I say it twice because I want you to get it. So what do we do as safe money advisors? We concentrate on guaranteed risk-free streams of retirement income, not affected by market performance, income the retiree and the spouse cannot outlive. By far, this is the number one concern for retirees. So, how do you do it? You create your own personal pension plan. Only a safe money advisor can do that for you. It's generating reliable income while preserving capital growth for the long term. Have that income stream, and the other money in the growth bucket, you can preserve that, not have to draw it all down. Pull money out for all the extra goodies that you want. We call it play checks. I listened to a guy named Tom Hagner, and he has a whole webinar called Paychecks and Playchecks. Paychecks are your guaranteed income streams, like what we do, and playchecks is the money you have over here in the stock market. If the stock market does well, you have some extra dough. That's what we do. Okay. Now, I'm offering you a complimentary strategy session. I like to call it a discovery call. And I hope every one of you listening to this webinar will take me up on it. So what are we going to discuss? Well, first of all, this is just a one-on-one safe money strategy session. It's no cost, no obligation. It's not a sales pitch. I'm not going to try to sell you anything. It's a comfortable, no hype conversation regarding your specific situation and how I can add value to your retirement. But we'll discuss things like your risk exposure, especially if you're in the red zone, the 5 years before and the 5 years after retirement. We don't want you in the red zone. Don't lose any money. Social Security timing. We'll talk about tax efficient income planning, all things we've discussed in this webinar. Risk Roth conversion opportunities. Is it appropriate for you? Is it going to work for you? Is it something you might want to consider? How to create your own personal pension plan. That's the number one thing. That alone is something that every one of you should be talking to me about if you don't already have one. Why Ike now? Well, don't remain in the red zone. Let's get you out of there. Tax-free growth opportunity. You want to get that, you want to grow your tax-free assets as much as possible, and you want to start it now if you have time to make that conversion. Inflation continues. Look, folks, we can set up a personal, well, let me start this way. Your financial advisor is going to say, take 4%, give yourself a pay raise. We talked about that. 4%. More than that, you're going to run out of money for sure. Well, how about if you had 5, 8, 10 years before you retire, and you put a bucket of money here, and we could exponentially grow that, multiply it, so when you get to the time you need the money for retirement, you will have more money than if you would have left it where it is, and you can take out maybe 5, 5.5, 6, 7%. So we can increase the amount of money that you take out in retirement, and it's guaranteed for life. No matter what the market does. Even if the accounts run out of money, you're still going to get paid. IRMAA surcharges are increasing. So I don't know what IRMAA charge is going to be in 10 years, or going up 6 to 8% a year. You could end up paying $1,500 a month for some of you or more on IRMAA charges. Well, if a Roth conversion is a good thing for you, let's get it done. RMDs are getting closer. You're not getting any younger. So let's hurry up and do something. Put some good strategies in place before you reach RMD if you're not already there. If you're there already, there's still things we can do. Don't forget to ask me about long-term care, how we can set you up for that, how we can take a very small part of your assets and triple or quadruple them in for long-term care, not cost you any premium out of your pocket at all. And if you end up in a long-term care situation and you need 50, 80, 100 grand, it's going to pay out tax-free, not going to spike your taxes or your IRMAA rates. Again, only safe money guys know about this. All right, how to schedule your session. You can call me directly at that phone. You can visit my website. You can scan the QR code there to the right, take you to my scheduling page. You'll receive a follow-up email after this webinar, and you can get with me there. First meeting is usually on the phone, and hopefully you'll want to meet with me again after that. And those are usually virtual meetings. Okay, that's it. Thank you very much for sticking around during this webinar. I know you could be looking at all kinds of things, and I'm glad you took some time to watch this webinar. I just want to wrap it up by saying that you can remove the stress and uncertainty from your retirement. You can bulletproof your retirement. Don't you want to have a don't worry, be happy retirement? You absolutely can. You can do it if you want to. Okay, off to the right, you see my wife and me. We're at Orange Beach, Alabama. It's our happy place. We go there quite often. And there's another picture, my wife and I, with my beautiful granddaughter. She just graduated from Auburn University in December of 2025 as an industrial engineer. She's now working with Alabama Power, got a great job, making a great income. We're very proud of her. So just a little bit about our lives there. Again, Victor Cuevas, Safe Money Advisor with Victor for Advice. I hope to be talking to each and every one of you that's watched this webinar. God bless.